The interest in guaranteed lifetime income and its importance to aging Canadians is growing rapidly. According to the 2018 Canadian Guaranteed Lifetime Income Study, 80% of Canadians see it as a highly valuable supplement to government benefits. Less than half, or only 45% of those who have financial assets of $100,000 or more, are highly confident in their ability to maintain their standard of living in retirement. And there are gender differences to consider. How can you provide contractually guaranteed lifetime income to address the needs and expectations of your aging clients? My name is Peter Wouters. Welcome to this trip with me on getting some answers and then leaving with some tangible ideas of the income market opportunity. Specifically, learn from a number of case studies on how some income approaches meet the criteria set by today's aging Canadians. This, of course, is part 2 of the session, Guaranteed Lifetime Income, the 90% Factors, Creating Your Personalized Pension Plan. As always, I need to remind you that this presentation reflects the views of Empire Life as of the date published. The information in this presentation is for general information purposes only and is not to be construed as providing legal, tax, financial, or professional advice. And the Empire Life Insurance Company assumes no responsibility for any reliance on misuse or omissions of the information contained in this session. A description of the key features of the individual variable insurance contract is contained in the information folder for the product being considered. Remember that any amount that is allocated to a segregated fund is invested at the risk of the contract owner and may increase or decrease in value. Fall is often referred to as income season or RIF season, Registered Retirement Income Fund season, since older clients begin to think about moving their registered retirement savings plan over to a registered retirement income fund, and in general, they start to take an income from their investments at this time of year or set up their affairs now to begin income payments sometime after January. January and February are historically referred to as RRSP season, since clients start thinking about contributing to a registered retirement savings plan or topping up contributions that they have made over the previous year to maximize eligible contributions. It falls on the heels of income season or registered retirement income fund season, when older clients think about moving their registered retirement savings plan over to a registered retirement income fund and in general set up their investments to begin taking out an income. As we sit here, it should almost be the other way around, considering the 2 sessions and 2 seasons are back to back. That said, it makes sense to plan ahead with where clients put their money to optimize their opportunities when they eventually and systematically take out their money. Today, we're going to touch on the opportunities in the guaranteed income market through 2 series of case studies. Each series will focus on a single solution, recognizing that individual needs vary and solutions generally involve a number of tactics, tools, and strategies. So we'll be covering, again, guaranteed lifetime income, the why and how much, with a focus on client needs, going through various case studies highlighting those key needs. We'll be sharing with you some options for pensionizing personal assets and highlighting some income solutions for that. This session will review the questions again of what, why, and how much guaranteed lifetime income products and how much people value these things and what they're actually looking for, and of course, how these products can satisfy their needs. Before we go into a number of case studies, let's quickly review what Canadians want in terms of pension plan style retirement plan features. And this, of course, was covered off in the session, Guaranteed Lifetime Income, the 90% Factors. These results on the screen came from the 2017 study, Designing Retirement Schemes Canadians Want. On a scale of 1 to 10, here are the average rankings of the top 5 features Canadians want. 1. I want a retirement income that is guaranteed to last my entire lifetime. 2. I want a retirement income that is predictable. 3. I also want retirement income that keeps pace with inflation. 4. I want a pension or retirement savings plan that will provide income if I am forced to retire earlier than planned. And 5. I want an income that does not fluctuate with investment results. The 2018 Guaranteed Lifetime Income Study found that there are gender differences in concerns about retirement and income needs. For instance, 1/3 of women are highly concerned about being able to maintain their standard of living in retirement. Almost 4 out of 10 women fret about long-term care expenses in old age. This is understandable when you consider that women live longer than men and a higher proportion of elderly women live alone and in poverty. Keep in mind that all of these things as we go through the case studies. So why more guaranteed lifetime income? Well, remember that average life expectancy has been increasing to the late 80s for men and women who have already reached age 65. Remember, too, that life expectancy measures the point where half the people have passed away. The other half will live longer. And living longer costs more. Maintaining health, recuperating from a sickness or illness, or dealing with health issues costs more too. And that adds to the ongoing fear of outliving your income. Many Canadians are not eligible for maximum benefits under the Canada Pension Plan or Quebec Pension Plan or Old Age Security, or may see those benefits drop when a spouse passes away. Fewer have defined benefit pension plans through work. And these points all come from a study using Statistics Canada data entitled New Facts on Pension Coverage in Canada. For those retiring workers with defined contribution pension plans, retirees still have to figure out how to turn those assets into a lifetime income for themselves and their partners in life. That means a quickly increasing number of aging Canadians do not have an adequate base of guaranteed lifetime income in retirement provided by others. Market volatility and contributing factors to it make guaranteed lifetime income more appealing, especially to cover regular fixed expenses. There is an ever-increasing onus on individuals to ensure they structure their long-term assets in such a way that they have sustainable, secure income through the various stages of retirement and that the income flow is guaranteed, freeing up their worries, the worries of their partners, children, and those who may need to step in and manage their financial affairs due to the incapacity of these aging Canadians. The case studies that follow go through a number of different yet common scenarios. Before we begin these case studies, I'll set the stage by talking about the importance of focusing on your client's needs when it comes to possible income solutions. Clients will have a variety of needs to be taken into consideration when selecting income products. For example, the need for setting up their plan for guaranteed income, a need that is increasing every year as fewer employees have access to guaranteed income through defined benefit pension plans. Two-thirds of people aged 55 to 75 like the idea of guaranteed lifetime income. This value held by Canadians for guaranteed lifetime income is in addition to government-sponsored plans, as was covered off extensively in the session, the 90% factors, guaranteed lifetime income, creating your personalized pension plan. There may also be a need for tax-efficient withdrawals from non-registered accounts to reduce government benefit clawbacks, a need for flexibility in the amount of income that can be taken in a particular year, as well as estate planning considerations like probate and estate bypass. And finally, where your client is in their retirement planning life cycle also has a huge impact on the products that may be best suited to meet their client's needs. Finding a product or products that will effectively meet all of these needs is a tall order. Depending on your client's specific needs, the income strategy you create may encompass a combination of products, since each product will meet some of those needs, but perhaps not others. However, some of your clients whose needs are more defined, a single income solution may be appropriate. And that's what we will cover today in facilitating your understanding of how, where, and why each one fits. So why do aging Canadians want guaranteed lifetime income? It's easier for them to maintain their lifestyle. It simplifies their financial management, and it allows them to focus on their lifestyle. Lastly, it makes it easier for family or caregivers to manage when they become incapacitated. As you've heard me say before, elders do not want to be a burden on their children. Health, mobility, and cognitive issues can impede people's ability to access financial services and make informed financial decisions, to act on them promptly, and be protected from financial exploitation, from elder abuse and fraud as they age. Social isolation, loss of control, and independence are key worries that plague aging Canadians. Having a certain amount of guaranteed lifetime income or cash flow coming in to handle regular or fixed expenses simplifies the lives of aging Canadians and the family members who may need to step in and help manage their finances while, of course, juggling their own financial affairs and complicated lives. I'm now going to show you 6 client case studies where there is a need for a guaranteed income solution. Then I'm going to show you how either a particular product or a combination approach may match the income solutions your clients are looking for right now. Each case study will demonstrate how the solution allows the individual to achieve their goals simply and effectively, while also making it easier for family or caregivers to manage these people affairs and those structures when those people become incapacitated. Meet Mike. Mike is 73 years old and retired. He's got a healthy retirement income coming in from a defined benefit pension plan and other investments. He also has about $1.2 million invested in a non-registered guaranteed investment fund account, which he plans to provide as an inheritance for his grandchildren, who he has named as the beneficiaries for this policy. While Mike doesn't plan on using these investments to fund his retirement, he wants to maintain control of these investments until he passes away. Two of Mike's grandchildren, Jen and Steve, have begun their careers, purchased houses, and have started families with their spouses. Mike has no concerns that Jen and Steve will put their shares of the inheritance towards good use. However, Mike is concerned that Mitchell, his last grandchild, may not be as responsible with a sudden six-figure inheritance. Regardless of their fiscal responsibilities, Mike loves all of his grandchildren equally and wants them to all benefit equally from his non-registered guaranteed investment fund account when he passes away. How might Mike meet his need for a flexible inheritance solution? Meet Jeff and Maggie. They've been happily married for 35 years. Jeff had two children from a previous marriage, Jeff and Jeremy, who each have families of their own. He passed away recently from a stroke, and he had been Maggie's caregiver. Jeff owned $1.2 million of permanent life insurance. Maggie is a semi-retired writer and proofreader, and between book sales, royalties, and inheritance from her parents, she managed to set aside money in her registered retirement savings plans, her tax-free savings accounts, and accumulate a $1 million non-registered investment portfolio. She and Jeff had lived comfortably off of their retirement savings. Jeff and Maggie both wanted Maggie, the second spouse, to be able to stay in the family home, recognizing that Maggie needs assisted living. Maggie has a daughter of her own who is a single mom with two children, Stacy and Steve. Maggie would like to provide financial support for her grandchildren's post-secondary education. How can Jeff provide for his own children while taking care of Maggie? And how can Maggie make special provisions for her grandchildren, Stacy and Steve? Our final client scenario for part one of this session is Mary, who is 70 years of age, in good health, and very active in the community. Her husband passed away 2 years ago. She has two adult daughters with children of their own. Mary is interested in leaving a legacy to children and perhaps a charitable bequest. Mary's income sources are derived from survivor benefits from her husband's work pension, the Canada Pension Plan, old age security, a modest equity portfolio, and a sizable fixed income portfolio comprised of GICs and T-bills. Mary's fixed income investments total $400,000, with the average rate of return on her fixed income portfolio being about 2%, and most of it is sitting in GICs. Her marginal tax rate is 40% for purposes of this illustration. Despite Mary's modest lifestyle and various income sources, she is concerned about future income needs. She's concerned about low interest rates, market volatility, inflation, and her grandchildren's future. She does not want to take on increased risk with this money. She doesn't want managing all of her financial affairs to be a burden on her daughter either. How can Mary increase her rate of return without dipping into her capital and still be able to leave a legacy to her children as well as a charity? How can she set this up to make it administratively easy for her and her daughter? By now, many of you have probably guessed that a solution for all of these three clients is pensionizing some assets using an immediate annuity. Annuities are a source of income that can be appropriate for clients who are looking for guaranteed income for life or for a guaranteed income for a period of time on a worry-free, maintenance-free basis. In many ways, the payments from an annuity can be thought of as being similar to the payments a client may receive through a defined benefit workplace pension plan once they've begun taking income. While the payments will continue for the life of the client, there's no way to access the assets, so there's no access to capital after purchase. Empire Life offers a single premium immediate annuity, which allows your clients to select the type of income stream they need to meet their needs and can be purchased with registered, non-registered, or locked-in funds, as well as the proceeds of life insurance policies as a predetermined settlement option. Let's see how the Empire Life Immediate Annuity can help Jeff, Maggie, Mike, and Mary meet their goals. As you recall, Mike was looking for a flexible inheritance solution to reward his grandchildren who were the beneficiaries on his Empire Life Guaranteed Investment Fund policy, and do that equally when he passes away, but in a way that is suited to their fiscal responsibility. Mike's advisor recommended the Empire Life Annuity Settlement option as a way to choose how the proceeds of his death benefit are distributed. The annuity settlement option is available on all Empire Life investment and insurance products, new and existing. The annuity settlement option allows Mike the ability to choose how each of his beneficiaries receive their death benefit proceeds, either through a lump sum or via a series of structured payments through an annuity. Since Mike doesn't have concerns about Jen and Steve's fiscal responsibility, he chooses for each of them to receive their death benefit proceeds via a lump sum payment. Mike is concerned about Mitchell's ability to handle a large lump sum, so he chooses to have Mitchell's share of the death benefit proceeds paid out via 10-year term certain annuity. With a term certain annuity, Mitchell will receive his $100,000 from the $300,000 guaranteed investment fund in equal payments over a 10-year period. Now, it's important to note here that any annuity settlement option designation is part of the policy's beneficiary designation and is kept private. So Mitchell would not know that his siblings received their payments as a lump sum unless they told them so. So it can stay private. And as the owner of the policy, Mike retains the ability to change the payout structure at any time. So if in a few years Mike thinks that Mitchell would now be able to handle a lump sum in whole or in part, he can simply change the payout option for him. Let's go back to Jeff and Maggie. They had a blended family. Jeff had 2 children from a previous marriage who have families of their own. Again, he passed away recently from a stroke, and he had been Maggie's caregiver. Jeff owned $1.2 million of permanent life insurance. Maggie has a daughter of her own and is a single mom. She has a registered retirement income fund, a tax-free savings account, government benefits, and some residual monies from Jeff's registered retirement income fund. She also owns a $1 million non-registered guaranteed investment fund portfolio. She valued the guarantees this program offered, including death benefits, downside protection, and resets. Maggie and Jeff wanted Maggie to be able to stay in the family home, recognizing that Maggie needs assisted living. The question was, how can Jeff provide for his own children while taking care of Maggie, and how can Maggie make special provisions for her grandchildren, Stacy and Steve? Let's consider first off the death benefit proceeds from the $1.2 million Empire Life Insurance contract. 5% of that can be paid as a lump sum payment to cover estate and funeral expenses. 45% of the proceeds can be paid out to the adult stepchildren from Jeff's first marriage, and half of that money can be put into a single life annuity with a 5-year guarantee to fund ongoing assisted living care for Maggie. What makes the Empire Life Annuity Settlement option different? Well, most annuity settlement options offer only a full lump sum payment or full annuity payment option. Our annuity settlement option lets clients choose any combination of lump sum and annuity payments. And that gives clients the ability to design a custom solution that meets their unique needs and wishes. And by the way, this settlement option is fully commissionable to the advisor with no setup costs or administration fees for the client. Now let's consider the death proceeds from the $1 million of our Class Plus 3.0 contract, a guaranteed withdrawal benefit plan. Stacy would receive a 20% lump sum payment to cover previous student loans, plus 30% of those monies paid out as a term certain annuity over 10 years. Steve, age 19, would receive a 10% lump sum payment to cover current education expenses, plus 40% term certain annuity payment over 10 years. Again, that's a lot of flexibility that's typically not available when you're looking at an annuity settlement option with carriers. And that's what makes Empire Life's proposition so different and so attractive. Now, what happens if a client has multiple beneficiaries? Do they all have to have the same payment options? Well, as you can see from this example, no, they don't. Clients can customize a solution for each beneficiary by electing different types of annuities, different guarantee periods, different payment frequency options, and different lump sum payments. Now, think about what that would cost in terms of setup, administration, time, and reporting without using this built-in benefit using a trust and some other funding vehicle. This valued option offers simplicity, quality, peace of mind, and predictability, something many people appreciate, something I pointed out in the companion presentation to this, Guaranteed Lifetime Income, the 90% Factors. And finally, we have Mary. As we described earlier, in many ways, Mary, a widow, is risk averse. She's nervous about losing her money and is a bit of a worrier generally when it comes to finances. A good chunk of her funds are very conservatively invested in GICs. And I'm sure you all have clients like Mary in your client base. Mary wants some extra guaranteed income and remains concerned that her term deposit or GIC portfolio may not generate enough without her dipping into capital. And that, of course, will put further strain in generating the same level of income and risk running out of money down the road. To address her personal income needs and family concerns, Mary's advisor suggests that she explore the opportunity of creating a guaranteed income and capital preservation strategy with $250,000 of her fixed income portfolio. Her advisor further suggests that Mary keep $150,000 liquid for emergencies and pleasure purposes. After discussing her options with her advisor, Mary decides to invest $250,000 of her fixed income portfolio into an Empire Life immediate annuity to generate guaranteed lifetime income and also purchase $250,000 of Empire Life Estate Max permanent life insurance coverage to leave a legacy. This strategy is commonly known as an insured annuity strategy. You will notice a twist in this case study that some people find valuable for its flexibility down the road. Here we have a comparison of two options. The first is the income that would be generated if Mary left the $250,000 in her fixed income portfolio against the alternative of putting it into a traditional insured annuity. So from $250,000 earning 2%, she would generate $5,000 of income, which would be fully taxable. At a 40% tax bracket, she would lose $2,000 in income taxes, leaving her a net amount of money of $3,000 to spend. If she moved $250,000 over into the insured annuity strategy, her gross annual income would jump to $14,700. The taxable portion would fall to $815.86. The tax payable would be $326.34, again, compared to the $2,000, leaving a subtotal of $14,372.91. Now, that's the income side, but remember, she's interested in leaving a legacy for her children. So we're going to subtract from that $10,775.79 to pay the life insurance premiums each year, leaving Mary with a net amount of money of almost $3,600. The advantage, almost $600, or equivalent to a 2.4% equivalent pre-tax rate of return. That average rate on the annuity side is provided by the top three providers using Canex. And again, as the interest in the GIC is fully taxable and Mary is in a 40% tax bracket, she's left with an after-tax income, as I said, of $3,000 were she not to do this strategy. The insured annuity strategy cuts the taxable amount and the tax payable by over 80%, which may help boost income tax benefits, tax credits, government benefits, and provide wiggle room for dividend income. Very, very important to her. And there's over a 20% increase of after-tax cash flow, a pre-tax return guaranteed for life. And after 16 years, an increasing legacy for the children, the charity, and or both, potentially up to over $400,000 by Mary's late 90s. That's equal to the full amount she started with age 70. And remember, the $150,000 not used in this strategy may still have been saved or reinvested. Now, I'm the first one to admit that the strategy does not work as well as it used to. The insured annuity has been hit with decreasing interest rates, increasing insurance rates, and increasing taxation. But over a 20% increase in after-tax cash flow and pre-tax rate of return with no increase in risk, in fact, a decreased risk, is not to be ignored in this interest rate and tax environment. Now, here's the flexibility twist. And again, she gets a 20% increase in net cash flow with no increase in risk, in fact, a decrease in risk. If Mary needs more income down the road, she can opt to have the life insurance paid up for a reduced amount and enjoy a higher tax-preferred cash flow of $14,372. Let's consider Mary needing that money 15 years down the road. She's going into a long-term care facility or assisted living, and she needs all of that cash flow. She can elect to have the life insurance go on a reduced paid-up value, and that paid-up value 15 years down the road would be $145,623. She can then spend the entire $14,372.91 after tax, because the taxable amount on that gross annual income is only $326.34. So there's a nice flexible exit strategy for people that figure they're completely locked in to that strategy. There is flexibility, and you can get that by using Empire Life strategies and products. Again, annuity quotes are available to you through Empire Life website by going to Business Building, get an annuity quote, and once generated, the quote can be printed and the application downloaded and completed with your clients. As you can see, while immediate annuities are often thought of as being inflexible, they can actually be the solution for a number of different client income needs. So if you have any clients like Sue, Mike, Maggie, or Mary, you may want to consider investigating whether an Empire Life single premium immediate annuity can help them meet their income needs. Now, let's take a look at 3 additional client scenarios. And just like before, there will be one product solution that is able to meet all of these client needs. Let's see if you can figure out what the solution is after I introduce Richard, Sarah, and Edward. Let's meet Richard. He just turned 65 this year and recently sold his small business with the intention of enjoying his retirement. Richard is a small business owner and doesn't have much in the way of registered savings. He'll primarily be using the proceeds of the sale of his business, about $1.5 million, to fund his retirement. Richard is a relatively savvy investor who plans on investing the majority of the proceeds of the sale into a diversified portfolio of equities and fixed income instruments. However, Richard's family has a history of living late into life, and he is concerned about the possibility of outliving his investments. Even though Richard is a savvy investor, he does value the certainty of having a guaranteed income stream in retirement beyond Canada Pension Plan and old age security. He would still like to maintain control of his entire portfolio and wants to have some upside potential from all of his investments. Richard has decided to allocate $750,000 to equities, $350,000 to fixed income, and the remaining $400,000 to a guaranteed income solution. How can Richard get the guaranteed income stream he's looking for, but still have upside potential? Now let's look at Sarah. Sarah, age 50, works full-time as a marketing executive for a firm that has a generous matching program for their workplace defined contribution pension plan. While Sarah is not overly concerned about having enough assets in her defined contribution plan at retirement, she is concerned about her ability to purchase a guaranteed income solution other than a traditional immediate annuity at her desired retirement age of 65. Sarah recently, and somewhat unexpectedly, received a $250,000 inheritance from a favorite uncle. She would like to use that to purchase a guaranteed income solution now that will be available to her at age 65. How can Sarah use the inheritance now to provide the guaranteed income she wants when she turns 65, 15 years down the road? And finally, we have Edward. Edward is turning 71 this year, which means that he now has to convert his Rich Retirement Savings Plan into a $300,000 of that Rich Retirement Income Fund he has into that Rich Retirement Income Fund and begin taking that income. Edward and his wife live rather frugally and both have a family history of excellent longevity. So while Edward doesn't plan on making withdrawals in excess of his required Rich Retirement Income Fund minimum, He is concerned that he and his wife could end up outliving their retirement savings. Edward is looking for a relatively steady income that he can count on for budgeting purposes and is concerned that market swings could result in him having to withdraw substantially more than his Registered Retirement Income Fund minimum in some years if there is a sustained market downturn. So, how can Edward get the stable income he's looking for in his retirement? The product solution to meet these three client scenarios is a guaranteed withdrawal benefit. These are income solutions that provide guaranteed income for life, allow clients to remain invested in the market for possible upside potential, and still have an estate transfer if there are assets left when the client passes away. Empire Life offers one of the few remaining traditional guaranteed withdrawal benefit plans in the marketplace with our Class Plus 3.0 product. Class Plus 3.0 offers clients the ability to begin drawing guaranteed income for life beginning as early as age 55 with unique payout rates going all the way up to age 80. The guaranteed income from Class Plus 3.0 can be increased through annual withdrawal deferral bonuses available the first 20 years of the contract, and also through triennial resets if markets are performing well, which lock in gains on those investments and make those guarantees and keep those guarantees relevant. Unlike a traditional annuity, Class Plus 3.0 allows clients the flexibility to stop, start, or change their income payments at any time, particularly when you're looking at a non-registered plan. Provided the client doesn't withdraw more than their guaranteed income each year, the guaranteed income from Class Plus 3.0 will continue as long as the client is alive, even if the market value of the product goes to zero. So let's take a look at how Class Plus 3.0 meets the income needs for Richard, Sarah, and Edward. As you recall, Richard wanted to invest $400,000 into a guaranteed income solution. After meeting with his advisor, he decides to purchase a non-registered guaranteed withdrawal benefit plan, our Class Plus 3.0 product, and selects one of the funds offering an 80% equity portion to maximize his upside potential. Richard, as you will recall, is a savvy, experienced investor who is quite comfortable with taking risk. He does value having a certain amount of his income guaranteed while being able to control how the money that is generating that income is invested. At the time Richard purchases the Class Plus 3.0 product, he is eligible for a guaranteed lifetime income of $16,000. The guaranteed income from a Class Plus 3.0 product is called the lifetime withdrawal amount. And this is calculated by multiplying the income base, set to equal the initial deposit of $400,000, by the payout rate for Richard's age, which at 65 happens to be 4%. Richard receives his $16,000 a year in guaranteed income for ages 65, 66, 67, and then in his 68th year, on his triennial policy anniversary, Richard receives an income-based reset since the market value of his policy in this illustration is greater than the income base. The following year, Richard's guaranteed income goes from $16,000 to $19,336. Richard receives another triennial income-based reset when he's 74. He didn't get one at 71 because the market had dropped, and his lifetime withdrawal amount at 74 is increased from $19,336 a year to $25,161. It's important to note that the triennial income-based resets occur throughout the life of Class Plus 3.0. Looking further ahead, you can see Richard receives a final income-based reset the year he turns 95. Richard's desire for a guaranteed income solution with upside potential is met by our Class Plus 3.0 guaranteed withdrawal benefit plan. So if that was a very positive outcome for Richard, let's be fair and take a look at a less optimistic scenario with Sarah. If you recall, Sarah was looking to ensure that she had guaranteed income streams available to her when she retires at age 65, in addition to her government retirement benefits coming from the Canada Pension Plan and Old Age Security. After meeting with her advisor, Sarah decides to invest the inheritance of $250,000 that she received into a non-registered guaranteed withdrawal benefit plan, a Class Plus 3.0 contract. Now, Class Plus 3.0 is available to be purchased in a tax-free savings account. However, Sarah had already maxed out her contribution room in that plan. As an aside, she could consider having her tax-free savings account funds invested in a guaranteed withdrawal benefit plan. The assets continue to grow tax-free, and the income is tax-free too. I mentioned earlier that the guaranteed income from a Class Plus 3.0 contract can be increased via the annual withdrawal deferral bonuses available for the first 20 years of the contract. We call these income-based bonuses. They're a notional bonus applied to the income base. As I mentioned in Richard's example, the income base is set at the initial deposit amount, in this case, for Sarah, $250,000, and is used to calculate the lifetime withdrawal amount when Sarah is ready to begin taking income. The bonus rate of Class Plus 3.0 is a guaranteed 4% of the bonus base, which is also set to the additional deposit amount. So in this scenario, even though Sarah's market value declines by 2% each year, her income base increases by $10,000 each year. And when Sarah is ready to begin taking income at age 65, even though the market value of her Class Plus 3.0 portfolio has shrunk from $250,000 to $136,000 in this illustration, her guaranteed income has increased from $10,000 to $16,000. And again, remember, at age 65, the payout rate is 4%, and it'd be 4% of $400,000. Now, obviously, this is an extreme example, but I use it to demonstrate how the income-based bonuses can provide your clients with additional guaranteed income at retirement, regardless of market performance. And last but not least, let's take a look at Edward again. As you recall, Edward turned 71 this year, so he has to convert his Registered Retirement Savings Plan, or RRSP, to a Registered Retirement Income Fund, or RIF, to begin taking income. After discussing his income needs with his advisor, Edward decides to convert his Registered Retirement Savings Plan to a Class Plus 3.0 Guaranteed Withdrawal Benefit RIF. Edward's advisor recommends Class Plus 3.0 because it not only provides Edward with an annual guaranteed income for life, it allows him to withdraw his Registered Retirement Income Fund minimum if it is higher than his guaranteed income without penalty in years where there is positive market performance. If the Registered Retirement Income Fund minimum, which of course is based on Edward's market value of his RIF, is lower than the lifetime withdrawal amount, Edward may withdraw that higher amount and without penalty. As Edward doesn't need to begin taking income from his Registered Retirement Income Fund this year, he is eligible for 1 year's income-based bonus, which helps boost his guaranteed income. In this example, for illustration purposes only, Edward's guaranteed income is the green bar, and the Registered Retirement Income Fund minimum is the blue bar. The Registered Retirement Income Fund value is based on an 80% equity, 20% fixed income blend using historical rates of return. As you can see, in some years, the Registered Retirement Income Fund minimum exceeds the lifetime withdrawal amount, which Edward is able to withdraw without penalty. However, in other years where markets have performed as well, Edward can withdraw the lifetime withdrawal amount from his Guaranteed Withdrawal Benefit Plan, or Class Plus 3.0 contract, and receive more money than the Registered Retirement Income Fund minimum would generate. With a Registered Retirement Income Fund, or Registered Retirement Income Fund that we call a RIF, invested only in a Class Plus 3 Guaranteed Withdrawal Benefit Plan, not only does Edward benefit from positive market performance that allows him to withdraw more than his lifetime withdrawal amount, it also can boost the guaranteed income through a triannual income-based reset. In Edward's case, he receives an income-based reset at age 74 and at age 80. For those of you who are looking to get a better understanding of how our Class Plus 3.0 Guaranteed Withdrawal Benefit solution works, or if you are ready to present the solution to any clients you may already have that look like Richard, Sarah, or Edward, I suggest you check out our new online Class Plus 3.0 Illustrator. Of course, reach out to our account executive team for more information and support in this area. The Illustrator can be accessed via any internet-connected device by going to the Empower Life Advisor site and then navigating to Business Building and Class Plus 3.0 Illustrator. In closing, Empower Life is a company you can trust for these types of products. We've been helping Canadians meet their financial needs since 1923. We're rated among the top 10 life insurance companies in Canada. We've been rated AA Excellent by the AM Best Company, and we've been managing segregated funds for over 50 years. We are committed to guaranteed withdrawal benefit plans and have been since 2008. And we offer diversified investment choices ranging from fixed income up to 100% equity, including our tactically managed Emblem guaranteed investment funds. Here are some closing thoughts. Aging Canadians want and value guaranteed lifetime income in addition to government benefits. They expect advisors to inform them of the options and how they can address their concerns and help fulfill their plans, as noted in the 2018 Guaranteed Lifetime Income Study. If you haven't seen the session, Guaranteed Lifetime Income, the 90% Factors, do so and learn just how valuable this concept is to aging Canadians. The case studies and applications used two products that don't seem to get enough airtime in conversations and educational sessions with clients. They demonstrate Guaranteed Lifetime Income in action and how well these products can help address the needs of the many aging Canadians that are around, and that number is growing every day. As I mentioned at the beginning of the presentation, not only is each client's income needs unique, but each income solution available has its own benefits and features as well as drawbacks. And in many cases, your clients may actually be served best through a combination of two or more different income products, in addition to various retirement income strategies. Take in my session on why segregated funds, or take a deeper look into why these products should be part of your client sessions. And by the way, pick up the newsletter that covers just one of those benefits. Yes, the entire cash flow out may not need to be guaranteed. It's important to allow for flexibility to adapt to changing circumstances. It's equally important to allow for growth in the overall portfolio to deal with longevity and potentially higher costs far down the road. Again, what we're sharing is that there is no one right way or product that can do all these things. The case study simply simplified that so I could highlight particular features and benefits that address the particular needs that each of those people in the scenarios had. There are certainly pitfalls we want to avoid and opportunities that we want to create. I trust that what I have shared with you today will guide you on your retirement income trips with clients, keeping you both safe and secure while optimizing retirement income needs and satisfying your clients' goals.